Yo, welcome back, guys, to First Hand Effects, the home of blues. Today, guys, I'm going to talk about very powerful tool used to take your reversal trades. Usually, we have so many reversal patterns, but today I'm going to first talk about the double top and the double bottom pattern. Okay. So if you're new to my channel, guys, smash that subscribe button and smash that like button. Please stick around, guys, and I will appreciate. And don't be a morifest, so don't run. Stick around, guys, and enjoy the course. It's going to be lit, guys. Okay, so let's get started, guys. So first things first, let's now talk about, we have a double top and a double bottom. Okay, so as an introduction, the double bottom pattern, which is just a W shape, is a bullish reversal formation on the candlestick chart, though it can also be visible on the bar and even line charts. It's also conveyed as a mirror of the double top pattern called the M shape, which is a bearish reversal pattern. All right. So in other words, this is what I'm talking about. We have a double bottom, which is just an M like this. All right, that's called a double bottom. Then double top is just the opposite of this, which is a mirror, an M shape, just like that, an M shape like that. Okay, so of course the pattern can also relate to the trader's psychology, and it's best suited for analyzing the intermediate to longer term view of market. But the best part is they work exceptionally well in a forex market. All right, so let's continue. So what's a double bottom? I just told you the double bottom pattern forms when the two price bottoms are positioned at relatively the same level while a neckline acts as a resistance. This pattern shows up at the end of a downtrend and signal is reversal. Okay, so let me explain this, guys. Okay, so like I say, maybe price so the double bottom, like I say, this position related at the same level while a neckline reacts as a resistance. This pattern shows up at the end of a downtrend and signals its reversal. Okay, so let's say the price was moving down. Now this is a downtrend. So when how do you know that the price now wants to start reversing? So this is what I'm talking about. We have price will push up, then push down, then now this. So this is now, when I draw this now, this is called the neckline. Now that's the neckline. So as you can see, this is now a double bottom. All right, this is a double bottom. So this is just a signal that now the downtrend is coming to an end, and now price is ready to push up back. All right. Alright, so typically traders will usually wait for the price to break above the neckline to go for long position. Exactly. So most of the time one has to wait for a break above this neckline over here, this zone, before taking that buy or taking your long position. But still, you should only go for long if you are confident, because there are chances where you'll end up trading against the trend. Okay. So the key to using a double bottom pattern is the longer the duration between the two lows in the pattern, the greater the probability that the chart will be successfully. Okay, the greater, I mean, the longer these durations over here and over here, okay, will be a great signal for a successful trade. That also translates to the fact that this technical analysis indicator is more suitable for long term trade, as it supports the exploitation of recurring patterns, guys. Still, there are mistakes you should avoid for more accurate analysis. That said, when a double bottom is used correctly, the results are quite impressive, but it can also be detrimental when you are not careful. So how does it work, and how do you even spot them? Alright, so let's continue. So how can we identify this double bottom pattern? To determine a double bottom is not as difficult once you lay hold onto the fundamental. It is one of those patterns that shows up regularly, visible, and provides a decent signal. The pattern is differentiated with its three main characteristics, guys. So please guys, be keen over here. So we have the first low. This is when the price bounces back to the first, for the first time, the first low. Okay, so as you can say, this is now price. Let me draw that once again. So let's say price was trending down like this. Okay, but then now we want to identify, this is the first low when the price bounces back for the first time. So this is what I'm talking about. The price will go up. Okay, but then you see we have another bounce. Okay, so that's the first bounce. Okay, that's the first low. So we have, this is a new high, but then this is a low. Then we have the second low. This is the second price rejection. Okay, let's go. Now, like I said, this is a neckline. Okay, then okay, now this is a neckline. Okay, that is a temporary resistance that forms between the bottoms, right? So let's go. Now here the market so this is the market psychology behind this formation. For the first low, during the first low, the market rebounds and creates a swing low. You may think that it's a common retracement showing up in a downtrend, but then we have a neckline during which forms during a retracement, and the price reaches a point of resistance and then goes back to retest the newly formed support again. This is now the support that I'm talking about, guys, is over here. Let me draw this. Boom. Now that's a support. Okay, so when we talk about the second low, the bears are eager to see whether the first bottom provides enough support over here. This one, does it support? Okay, let me, sorry about that, with the drawing tool. All right, this over here. Okay, so the bears will ask themselves a question: does this neckline, does this second low provides enough support to the first one over here? So this one over here, this is the second low. Okay, so bears are eager to see whether the first bottom, this first bottom, provides enough support. If the price breaks below the first low, we don't have a double bottom anymore. However, if the second bearish attempt fails near the support formed by the first low, then we can observe the pattern clearly. Still, it's too early to enter the market, right? Okay, so we have a break of neckline. So what happens when the price breaks this neckline over here? So when the price breaks the neckline, this neckline over here, so what happens? Okay, once the market rejects the second low as well, the price is rebounding again. If it manages to break above the neckline, which we previously defined as a resistance, then the traders will be interested in going long, as bulls are in control from now on. And that's it. That's how clear and straightforward the double bottom pattern is. Okay, but then I can also this is just how to trade a double bottom, guys. But then I also have my sniper entry that I usually talk about and usually use to take my trades when I see the double bottom and the double top. Okay, so instead of waiting for this neckline to be broken, guys, okay, I usually wait after seeing, let me delete this, after seeing just this and seeing some rejections, guys. I usually wait for a bullish candlestick to engulf this one. From then I take that by entry over here. Boom. Then I can target, my first take profit should be here. Boom. Then my stop loss usually below the previous wick or support there. That's how I enter the market. Okay, so boom, and then if it breaks, then wait for a retest before going up. All right. Okay, so how to use we've already talked about that double bottom thing. So we have the breakout techniques. When trading the double bottom, most traders will enter the market right after the price break above the neckline, but you can try a different approach that I've just showed you guys. Instead of waiting for a clear breakout to form, you can stay calm and watch the market a bit. The price can potentially reverse lower right after breaking above the neckline. You want to see visible strength from bulls instead of hesitation. So here is how you can proceed. Just first things first, you need to identify a double bottom pattern information, then let the price action break above the neckline, guys, over here, or wait for a regional pullback. That's what I just talked about. Just wait for this pullback, maybe the chain of range candlestick. Just wait for that engulfing candlestick and go long when the price breaks the swing high, which coincides with the neckline. That is after seeing the bulls are in control with that engulfing Barobozu candlestick. In other words, you should not hurry to open the buy order when the price is breaking above the neckline, but instead wait to see whether there is a pullback, and this way you are making sure that when you are entering the market, bulls are strong enough. Okay, so you can trade the double bottom whenever you spot it, especially when existing bearish trend reach the oversold level. For this, you can employ technical analysis. Okay, all right. A good note is that the two lows might not always be at the same level. More often, the second bottom might go lower as bears try harder to break below the previous low. But if the price manages to bounce back from the second low, the pattern remains valid and is worthy of your consideration, guys. All right, guys. So please be wary that sometimes when such pattern shows up, bears are trapped as they go short right after the price breaks below the first low. That is signaling bulls, because bears are demoralized when the price bounces back. That's why I usually take my trades before, when I see that pattern wants to form. I usually take my trade over here. At least I can scalp up before, because maybe the market might not break that neckline. That's why I take my trade and then take my profit when the market reaches the neckline, and wait and see if it breaks and give me that clear pullback. Then that's when I'll take another buy, and if it doesn't, I don't do that. Okay, all right. So guys, that was a double bottom. So now let's talk about the double top, the reversal or the mirror of these. Okay, so a double top is a bearish reversal pattern that signals the end of an uptrend. It is formed by two price highs formed at the same level and a neckline that acts as a local support. Traders will wait for the price to break below the neckline, after which they open their short position. All right, so literally this is what I mean. Now let's say price has been trending up. Okay, now price want to start reversing. Okay, so the first things first, like I said on the double bottom thing, now this is usually what's happening. Price will go down, then price will come back. Okay, after that price will form that boom. So we have a neckline over here, that's a support, and a resistance over there, guys. Okay, as you can see, we have an M shape. Remember, the double bottom is a W, and then double top is an M shape, guys. Okay, M. All right, so let's continue. So how do we identify a double top pattern? You can observe double tops quite often, though some of them might not be ideal. The pattern consists of three main elements. We have the first high, which is when the price retreats from the first time. The first high, we have this over here. Okay, this one. Then we have the second high. This is the second price rejection, this one. Okay, the first time price is here, that's the first time high, then another high for price rejection, then now a neckline over here, which is a temporary support that appears between the high over here. That's the support. Okay, guys, so how do we use a double top? When the market reaches the overbought level, it might face resistance and form the double top pattern. It starts with the first high when the price retreats until finding a local support. Okay, at this time you can't detect the pattern, but then after the first top, the price pulls back until the support, which is now the neckline, and then bounces back to test the newly formed resistance again. If the price can't break above it, it will form a second high. That is when traders wary of the trend and should get ready to short when the price breaks below the neckline. Okay. All right. So let's remove this and go back to practical. So this is what has just happened. For example, now price has gone back to retest this resistance. Usually it is advisable for now, let's say, bears to wait for a break below this neckline, now pull back before going short. All right, but then I usually, like I said before, the same way I did take my trade on the double bottom, this is how I usually take on the double top. So I just wait for an engulfing candlestick. That's my strategy. Okay, just wait for an engulfing candlestick, guys, over here. But then if the candlestick has to engulf this previous candlestick on the left, then it has to be bearish this time. Then I take that sell entry, adjust my stop over here. Okay, then first take profit should be there around now the support. Okay, after that I take, after the price maybe hits my take profit, I usually now stay away of the market and wait to see what happens. So if the price now breaks the neckline, I'll just wait for another pullback, rejection, and also another engulfing candlestick, guys, over here like this. Then take my second entry, now confirming now that the double top pattern has been formed and now the bears are now in control. That's how I take my entries, guys. Okay, quite simple, guys. Okay. All right, so you can use the same breakout techniques as in the case with the double bottom, but with now the inverted rules. Okay, now there's this question, guys. So are double bottoms and double tops suitable for in trading? Yes, of course. The two patterns are universal and they work well in all markets. Even maybe you are trading cryptocurrency, you know, apart from the market, in the forex market, these patterns still works, guys. Okay, so what the difference between the double top and the double bottom? So there's no fundamental difference between the double top and the double bottom thing, guys, except that they are total opposite. In other words, what's right for bulls in the case of a double bottom, the same is true for bears in the case of double top, as the latter is a bearish reversal signal. Okay, the double top is made up of two highs positioned at relatively the same level and a neckline, which at this time represent a local support. When trading forex on a large time frame, the approach for each of the two might differ, as a double bottom should appear more often given that forex market is thriving and will be there forever. Okay, so what's the pros and cons about these patterns? The great thing about the pattern is that they are effective on multiple time frames, be it the 15 minutes, an hour, 4 hour, or the daily. Both day traders, swing traders, and even position traders can use them. They are also universal patterns that work well in stocks, forex pairs, commodities, cryptocurrency, and what have you. Just like any other technical pattern, they have their metrics, but it also comes with drawbacks. The main disadvantage is that neither the double top nor the double bottom can guarantee that the newly formed trend will consolidate. For example, in the double bottom case, bears might find the courage to push price lower for the third time and even try to break below the support. Thus, traders should use great risk management tools like the stop loss. All right, remember, guys, I'm just always the champion of always using a stop loss. Okay, so we have some mistake that you guys should avoid. One of the main mistakes of those who trade the double bottom is to go long immediately after the price breaks above the pattern snake line. In this case, if you're not cautious, you might end up trading against a larger trend. If the market is in the middle of a strong bearish move and forms a small double bottom pattern, it will most likely ignore it and continue its general direction. Okay, so to avoid this, you should always be careful, guys, before you take the trades. Just wait and see what the market tells you before entering the market. Just flow with the market. We have the candlesticks, guys, and I will also make a video talking about the candlestick, the Japanese candlestick, guys. So the risk management about this reversal is that, well, while double tops and double bottoms are some of the most reliable chart patterns, they cannot guarantee trend reversals on all occasion. To avoid significant losses that may affect your entire balance, you should apply this some basic techniques to mitigate your risk. The most crucial step is to place a stop loss order, which will reduce the potential loss if the price suddenly moves against you. Okay, so a stop loss should be set between the breakout, that is maybe the neckline, and the resistance in case of a double top, or support in the case of a double bottom. All right, so to promote the consistency and focus on the long-term goals, you should not use more than 1% of your balance per trade. And that is one of the golden rules of risk management. However, if the market is volatile and you are tempted to hit the jackpot by going all in, you might indeed be lucky for once. You will not be guaranteed the same luck in the long run if such practice turns into a habit. Right? So then now we have the closing thoughts. The double tops and the double bottom are some convenient and reliable chart patterns, guys. Yet the rest of successful really depends on your ability to convert their signal into successful trades. So to improve your trading skills with this chart information, you can start by practicing on a demo account, guys. Just before using this strategy, always use the demo before putting in the real money, guys. All right, so don't forget to keep an eye on the technical indicators, especially those measuring the overbought and oversold levels. All right. Okay, so now let's check, guys, some of the patterns in the real forex market, guys. Okay, so currently I'm in this trade. We have the Aussie against the dollar. So this is now what I'm talking about. Okay, we have a certain bottom over here, first bottom, then the second bottom over here. All right, so like I said before, that the price has now formed new low. All right, then came back from the second low before now trying to see if it can break this neckline. All right, so usually the best thing is to wait for that price to push up, wait for a retest to the neckline and rejection before going in. But then remember my strategy, guys. Like I said before, I just when I see this double bottom, now my strategy is I just wait for an engulfing candlestick. Like we have this engulfing candlestick over here, we have this bullish candlestick over here that engulfed this one. That's why I took this trade. So currently I'm still at a drawdown, but I'm anticipating now the price going to to see if it can break this neckline, which now are resistance, before confirming this double bottom thing. But then I don't usually wait for, I just don't want to waste this movement before seeing maybe price breaking. So when the price is up, when the price is trying to go to retest that resistance, I want to flow with the price and maybe lock in some profit before breaking, or seeing some rejection maybe to go down. So that's just what's happening. That's just one of the example of a double bottom thing. We also have one over here, guys. We have this now. This is called a double top, guys. As you can see, we have a new, the first high over here. Then now we have the second high over here. All right. So that's what happened. So as you can see, first price went up. Then now price came back. Then went back to retest now the resistance. Then now, like I said before, I usually just don't waste the move, guys. The moment I see an engulfing candlestick, guys, that's when I enter. So you all can see that price came in and then engulfed. We have this candlestick engulfed the previous one over here. So that's great. Just taking your sell entry over there, then now target the neckline or the support over there. That's around 125 pips, making a stop loss tighter above the previous resistance, maybe 27 pips, right before taking that sell entry. As you can see, guys, price came and then broke that neckline or support, guys, before going it down. But then after that break, now for a great confirmation, now we have this retest, guys. So you can see price broke this, then price went now to take that retest before going down. But then I was not there now. This is why I usually like taking these trades before the break of a neckline, guys. That's a support or a resistance. So that's quite easy. That's the easiest way how I deal or take my trades, guys. So I'll just let this trade play out, guys. And yeah, so I hope somebody learned something, guys. So if you're new to my channel, once again, smash that subscribe button and smash that like button, guys. Please, guys, like this video and share with your friends too, guys. So until next time, amigos. Adios. I hope somebody learned something, and if you learned something, guys, smash that subscribe button. At least that's how I will feel motivated, when you smash that subscribe button and the like button, guys. So until next time, guys, adios, amigos.